Good afternoon, good evening, or good morning, depending where you are. Thank you for joining us today. In this webinar, we will provide an overview of the discussion paper, Business Combinations Under Common Control, that was published in November 2020. My name is Yulia Fekina. I'm joined today by Carlo Pereira and Paolo Dragone. We are all members of the technical staff at the ISB working on the Business Combinations Under Common Control project. Before we start, a few housekeeping remarks. As with all our presentations, any views we express today are our own views and not necessarily shared by the board or IFRS Foundation. You can submit your questions at any time during the webinar by typing your question in the question box to the left on your screen. We will answer as many questions as possible at the end of the presentation, which should take about half an hour. We will also be running survey questions during this webinar. We encourage you to vote on those questions. Your votes will be anonymous. If you would like to know more about the project, this slide provides a link to the project webpage, where you can find the discussion paper, supporting educational materials, and an explanation of how to submit a comment letter. The recording of this webinar and the slides used in this presentation will also be made available on the project webpage. At today's webinar, we will cover why the board is doing the project and the board's approach to developing its preliminary views. The board's preliminary views on when the acquisition method and a book value method should be applied to business combinations under common control, and a brief overview of how, in the board's view, each of those methods should be applied. Carla, could you please take us through the background to the project and the board's approach to developing its preliminary views?
With pleasure, Yulia. So why are we doing the project? IFRS 3 business combination sets out requirements for business combinations between unrelated parties and requires the acquisition method. However, IFRS 3 excludes from its scope business combinations that are under common control. This gap in IFRS standards resulted in diversity in practice. In some cases, companies use the acquisition method to report business combinations under common control, which provides fair value information about this combination. In other cases, companies use a book value method which provides historical book value information. Furthermore, there is a diversity in how a book value method is applied. Finally, companies often disclose little information about this combination. Business combinations under common control are common in many jurisdictions around the world, and stakeholders have asked the board to address this gap in IFRS standards. The diversity in practice in reporting these combinations is a particular concern for securities regulators. The board's objective is to develop requirements that would result in better information for users of financial statements about business combinations under common control. The board is not only looking to reduce diversity in practice, but also to ensure that useful information is provided about this combination, and transparency in reporting is improved. So let's talk about the scope of the project. The project considers all transfers of businesses under common control, including combinations undertaken in preparation for an initial public offering, because these transactions are not addressed by IFRS standards. In the diagram presented on the slide, the transferred business is Company C. The project only considers transfers of businesses under common control. It does not consider transfers of assets, groups of assets and liabilities, or companies that do not have a business. This is because there are no scope exclusions for such transactions in existing IFRS standards. The project considers reporting by the receiving company in a business combination under common control. In the diagram, the receiving company is Company A. The project does not consider reporting by other parties in the combination. This is because reporting by those other parties is already addressed by IFRS standards. Reporting a business combination under common control will typically affect consolidated financial statements of the receiving company. However, in some cases, when the transferred business is not incorporated, reporting a business combination under common control would also affect separate or individual financial statements of the receiving company. However, the project is not considering accounting for an investment in subsidiary in the receiving company's separate financial statement. This is because this topic is already addressed by existing IFRS standards. Now, in developing its preliminary views set out in the discussion paper, the board focused on information needs of the primary users of the receiving company's financial statement. More specifically, as illustrated on the slide, the board focused on the information needs of the receiving company's existing non-controlling shareholders, its potential shareholders, and its lenders and other creditors. The board did not focus on information needs of the controlling party, Company P. This is because the controlling party controls the receiving company, and therefore, it did not rely on the receiving company's financial statements for meeting its information needs. In contrast, non-controlling shareholders, potential shareholders, and lenders and other creditors of the receiving company must rely on that company's general purpose financial statements for meeting their information needs. The board also noted that different primary users can have different information needs. Therefore, depending on the composition of primary users in different business combinations under common control, their common information needs could also be different, and different information may best meet their common information needs. In principle, the board noted that if and to the extent that business combinations under common control are similar to business combinations covered by IFRS 3, the same information should be provided. And if and to the extent that these combinations are different, different information may need to be provided. These considerations are subject to the cost-benefit trade-off. That is, particular information should be provided only if the benefits of that information to the primary users outweigh the cost of providing and analyzing that information. Finally, in developing its preliminary views, the board also sought to avoid complexity and to eliminate the choice of accounting treatment by companies. In other words, the board sought to develop objective conditions so that companies could not achieve their desired accounting outcome by structuring the transaction in a particular way. And with that, Yulia, could you please take us through the board's preliminary views on whether and when the acquisition method and a book value method should be applied?
Of course, thank you, Carla. So let me take you through the board's thought process on this topic. In developing its preliminary views, the board considered stakeholder views expressed in initial consultations on this project. Broadly, stakeholder views fall in three groups. Some stakeholders argue that all business combinations under common control are different from business combinations between unrelated parties, and that they all lack economic substance. These stakeholders tend to view business combinations under common control from the perspective of the controlling party, and argue that the controlling party simply moves its economic resources from one pocket to another. These stakeholders suggest that a book value method should be applied to all business combinations under common control. Some other stakeholders argue that all business combinations under common control are similar to business combinations between unrelated parties, and that they all have economic substance for the receiving company. This is because in any business combination, the receiving company acquires control of a business that it did not control before the combination. For this reason, these stakeholders argue that the acquisition method should be applied to business combinations under common control, subject to the cost-benefit trade-off. Finally, some stakeholders argue that business combinations under common control are not all the same, and that some such combinations are similar to business combinations between unrelated parties, and others are not similar. Accordingly, in their view, the acquisition method should be applied in some cases, and the book value method should be applied in other cases. Despite that variety of views, common ground has also emerged. In particular, in our initial consultations, many stakeholders expressed the view that the acquisition method should be applied to business combinations under common control that affect non-controlling shareholders of the receiving company. And many stakeholders also expressed the view that a book value method should be applied to business combinations under common control that do not affect such shareholders, either because they view these transactions as being different or for cost-benefit reasons. So let us next look at what the board has concluded. The board has reached the view that business combinations under common control are not all the same, and that neither the acquisition method nor a book value method are appropriate in all cases. More specifically, in the board's view, in principle, the acquisition method should apply to business combinations under common control that affect non-controlling shareholders in the receiving company. However, this is subject to the cost-benefit trade-off. To take into account that trade-off, the board is also suggesting an exception and an exemption from the acquisition method for some transactions that affect non-controlling shareholders. In all other cases, in the board's view, a book value method should be applied. So let's first look at transactions that affect non-controlling shareholders. Such transactions can be undertaken by both publicly traded and privately held companies. Let's consider what happens in a business combination that affects non-controlling shareholders and in a business combination under common control that affects non-controlling shareholders. In both cases, the receiving company, Company A, acquires control of the transferred company, Company C, as illustrated on the slide. Furthermore, in both combinations, non-controlling shareholders of Company A indirectly acquire residual ownership interest in Company C, as also illustrated on the slide. Accordingly, in such a business combination under common control, the controlling party does not simply move its economic resources from one pocket to another. Even though there is no change in ultimate control over the transferred company, there is an acquisition of the ultimate ownership interest in that company by non-controlling shareholders of the receiving company. Accordingly, the board has concluded that in principle, such business combinations under common control are similar to business combinations covered by IFRS 3, and that the acquisition method would provide useful information about these combinations. The board then considered whether the acquisition method should be applied to all combinations that affect non-controlling shareholders of the receiving company, or only some of them. The board noted that in some such cases, for example, when non-controlling interest is small, the benefits of applying the acquisition method may not justify the costs. The board concluded that if the receiving company's shares are traded in a public market, non-controlling interest is likely to be significant enough due to public market regulation. Accordingly, in the board's view, the benefits of applying the acquisition method would likely justify the costs for public companies. Therefore, the acquisition method should be applied in such cases. If, however, the receiving company is privately held, its non-controlling interest might be small, or it might be entirely held by the receiving company related parties, for example, its key management personnel. In such cases, the benefits of the acquisition method may not justify the costs. Furthermore, if the acquisition method was required in all cases when non-controlling shareholders are affected in private companies, that could create opportunities for accounting arbitrage. In other words, companies might be able to structure a transaction with the sole objective of achieving desired accounting treatment. For those reasons, the board is suggesting an exception and an exemption from the acquisition method for private companies. Specifically, in the board's view, a book value method should be required if all non-controlling shareholders in a private company are that company's related parties. Furthermore, if not all of those shareholders are the company's related parties, the company would be permitted to apply a book value method if it informs all of its non-controlling shareholders that it proposes to use that method and they do not object. This exemption is based on an existing condition in IFRS standards. Moving on to business combinations under common control that do not affect non-controlling shareholders in the receiving company. Such combinations could be undertaken by private companies for regulatory or tax reasons or in preparation for an IPO. So there are no non-controlling shareholders, so the primary users of information about these combinations are the receiving company's lenders and other creditors, and its potential shareholders. So let's consider a pre-IPO scenario as an example. Suppose the controlling party, Company P, wholly owns and controls Company A and Company B. Both companies are businesses. Suppose the controlling party wishes to offer Company A and Company B in an IPO. Suppose in case 1, Company A and Company B are held by a holding company, as is illustrated on the slide. In that case, the controlling party can offer the shares of the holding company in an IPO without undertaking a group restructuring. In that case, historic book value information would be provided about both Company A and Company B to potential investors in an IPO. In contrast, suppose in case 2, the controlling party directly owns Company A and Company B. In that case, the controlling party would first need to restructure the group in preparation for an IPO. The controlling party could undertake the restructuring in a variety of ways, as is illustrated on the slide. It could establish a new co and move shares of Company A and Company B into the new co. Or it could get Company B to acquire Company A, or it could get Company A to acquire Company B. So if the acquisition method were to be applied to these combinations, then the potential investors in an IPO would receive different information about Company A and Company B depending on how the combination is structured and which company is identified as the acquirer. However, in all these scenarios, and regardless of how the combination is structured, potential investors in the IPO would be investing in the same economic resources as in case 1. For that reason, the board has concluded that similar information should be provided both in case 1 and in case 2. And that will be achieved if a book value method is applied to such combinations. Furthermore, the board also concluded that absent existing non-controlling shareholders, the benefits of applying the acquisition method would not justify the costs. In developing its preliminary views, the board also considered information needs of lenders and other creditors and discussed those needs with users of financial statements who specialize in credit analysis. The board noted that economic interest held by lenders and other creditors in the receiving company is different from economic interest held by non-controlling shareholders and is limited to payments of principal and interest. Accordingly, credit analysis focuses on the company's ability to service its debt and to raise new debt and requires information about the company's cash flows and debt commitments. In our initial consultations, stakeholders told the board that such information and the outcome of credit analysis are largely unaffected by whether the acquisition method or a book value method is applied to a business combination under common control. And just to summarize, to determine which method to use, it is first necessary to consider whether the combination affects non-controlling shareholders in the receiving company. If it doesn't, a book value method would be applied. If it does, the next question is whether the receiving company's shares are publicly traded. If they are, the acquisition method is required. If they are not, if receiving company is privately held, then the next step is to consider if all its non-controlling shareholders are the company's related parties. If they are, a book value method must apply. If they are not, the company may propose using a book value method and inform its non-controlling shareholders that it proposes to do so. If non-controlling shareholders do not object, the company may use a book value method. If non-controlling shareholders do object, then the company must apply the acquisition method. To conclude, I'd like to highlight that all the conditions used in the flowchart are based on definitions and conditions that already exist in IFRS standards. The board is not proposing any new conditions that are not already used in practice today. Furthermore, both the acquisition method and the book value method are also already in use today and are not new to companies. And this takes us to the first survey question, where I would be very interested to hear your views. So you should hopefully be able to see the questions on your screen. And the question really is, what are your views about the nature of business combinations under common control? Do you think they're similar to business combinations between unrelated parties? Do you think they're all different from business combinations between unrelated parties? Or do you think they're not all the same and some of them are similar to combinations between unrelated parties and some of them are not similar? And we would be very interested to see your views. I can see that votes are coming in, but not many votes so far. I will give you a few more seconds to get familiar with how to vote. More votes are coming in, and I can see some diversity in views, which is not a surprise. So I think at the moment you should all be able to see the results as they're coming in. And it's fair to say that the results we are all seeing is quite similar to those three different camps that we've identified earlier in this presentation. But I'm quite pleased and encouraged to see that most of you largely seem to agree with where the board has landed, which is business combinations under common control are not all the same, and they're not either all similar or all different from regular business combinations. So with that, let me close this voting, and let me pull up our next question for you, which you should be able to see on your screens now. And the question is, do you agree that in principle the acquisition method should be required for business combinations under common control that affect non-controlling shareholders, subject of course to cost-benefit consideration, and that a book value method should be applied in all other cases? Yes, you agree. No, you think the acquisition method should also be required for transactions that affect lenders and other creditors. No, you think a book value method should be applied to all business combinations under common control. Or you don't agree because you think a different criteria altogether should be used in determining which method should be applied. And again, I can see the first votes coming in, and now you should be able to see the votes as well as they're coming in. I will give it a few more seconds. Again, I'm quite pleased to see that while there is a diversity in views, but the overwhelming majority of those who have voted, not an overwhelming so far, but still a majority, seems to agree with the board's preliminary views. But of course, there is a diversity in views here. Okay, so let me end this survey as well. It was very interesting to see what you think. And let me go back to the slides. So this completes our discussion on when each method should be applied. And we're moving to the discussion about how those methods should be applied. Paula, it's over to you, please.
Thank you, Julia. So let's see how the acquisition method applies, but before, let's remind ourselves how it works applying IFRS 3. This method assumes that typically, in a business combination between unrelated parties, equal values are exchanged. Applying the acquisition method, acquired assets and liabilities are measured at fair value, and goodwill is measured and recognized as a residual, as illustrated on the slide. Such an amount will typically comprise goodwill that pre-existed in the acquired business and the price paid for synergies expected from the combination. In some cases, it's also possible that the price paid includes an overpayment which is recognized within the initial carrying amount of goodwill and subject to subsequent impairment tests. Occasionally, a bargain purchase can occur between unrelated parties. In those cases, a gain is recognized in the statement of profit or loss. The gain is measured as the difference between the fair value of the consideration paid and the fair value of the assets and liabilities acquired, as shown by the right-hand side of the slide. The board considered whether the logic and mechanics of IFRS 3 also apply to business combination under common control. And the board acknowledged that because combinations under common control are transactions with related parties, it's possible that in some cases the price paid is different from the price that would have been paid in a business combination between unrelated parties. Economically, such a difference would represent a distribution from equity of the receiving company to the controlling party, or a contribution to equity of the receiving company by the controlling party. The question therefore becomes whether the receiving company should be required to identify, measure, and recognize any such distributions and contributions. However, the board noted that the acquisition method would apply to those business combinations under common control that affect non-controlling shareholders of the receiving company. The board concluded that in such combinations, distributions are unlikely to occur because many jurisdictions have a legal requirement protecting minorities. And even if they did occur, it will be impossible to measure and to recognize these distributions separately from goodwill. For that reason, the board concluded that the acquisition method should generally be applied as set out in IFRS 3. The board also noted that if a bargain purchase takes place in a combination under common control, any such underpayment economically represents a contribution to equity of the receiving company, rather than a gain that is recognized in the statement of profit or loss. The board concluded that because business combinations under common control are related party transactions, additional information about transaction price should be disclosed. Slide 20 illustrates board's preliminary views on how the acquisition method would apply to business combination under common control. Assets and liabilities acquired will be measured at fair value, just as it occurs in a regular business combination. The difference between the fair value of the consideration paid and the fair value of net assets transferred will be typically recognized as goodwill, like under IFRS 3. If the price paid includes an element of overpayment, that overpayment will be recognized within the initial carrying amount of goodwill, as it also occurs in a regular business combination. However, if the price paid is below the fair value of assets and liabilities acquired, such difference will be recognized as a contribution to equity of the receiving company. And now, before moving to the book value method, I have a polling question for you. If the acquisition method is required for some business combination under common control, how should the receiving company apply that method? And we are interested in hearing your views about that. There are three options, as set out in IFRS 3, without no additional condition, as set out in IFRS 3, but providing additional disclosure, or as set out in IFRS 3, but recognizing a contribution and providing additional disclosure. Giving you some more seconds to vote to this question. And here are the results that overall, I am pleased to see that overall there is an agreement with the board's preliminary view. And with this, I'll move to the next slide and how to apply a book value method. Unlike the acquisition method, a book value method is not described in IFRS standards. And as Carlo noted earlier, there is a significant diversity in how book value methods are applied in practice today. For example, in some cases, companies measure the consideration paid at fair value, and in other cases, they measure it at book value. Also, in some cases, companies measure assets and liability received at the book values reported by the transferred company. And in other cases, they use book values reported by the controlling party. However, as illustrated in the slide, there is common practice in how the difference between the consideration paid and the assets and liability received is recognized. Typically, such difference is recognized as a decrease or an increase in the receiving company's equity. There is also diversity in how pre-combination information is provided, and we'll see that in the next slide. In some cases, companies apply a book value method retrospectively. This means that pre-combination information is restated to include all combining companies from the beginning of the first period presented, as if they had always been combined. In other cases, companies apply book value method prospectively. Under this approach, which is similar to IFRS 3, all combining entities are only combined from the date of combination, and pre-combination information is not restated and is presented only about the receiving company. The board has reached a preliminary view that a single book value method should be specified in IFRS standards. In developing the discussion paper, the board focused on the main aspects of how a book value method should be applied. Specifically, the board concluded that assets and liability received should be measured at the book values reported by the transferred company. The board noted that such an approach will result in an outcome that is similar to producing combined financial statements. The board also noted that book values reported in the controlling party financial statements are not relevant to the combination between the combining companies. Further, the board concluded that the consideration paid should be measured at its book value. However, the board does not suggest to specify how consideration in own shares should be measured, because this will only affect presentation within the receiving company's equity, and the board generally doesn't prescribe presentation in equity. Also, the board noted that measuring consideration at book value or at fair value will produce a similar outcome for some common forms of consideration. For example, that will be the case if consideration is paid in cash or by incurring financial liabilities. Next, the board concluded that the difference between consideration and the book value of the assets and liability received should be recognized in equity, consistently with the current practice. The board noted that splitting such difference in separate economic components and measuring and recognizing those components separately will not meet the cost-benefit trade-off and could effectively eliminate the differences between the acquisition method and a book value method. Finally, the board concluded that companies should be combined prospectively from the date of combination and that pre-combination information should be only provided about the receiving company without restatement. The board acknowledged that such pre-combination information about all combining companies could be useful. However, it will be hypothetical and it will portray a group that had not actually existed before the combination date. The board, therefore, concluded that including it in the primary financial statement is not appropriate. the board has not yet considered further detailed aspects of how a book value method should be applied. It plans to consider them in the next stage of the project after the foundations of the model are confirmed. And now we move to the last polling question for you about the book value method. Do you agree with the board's preliminary view that applying a book value method, the receiving company should combine the transfer company from the date of the combination? We are interested in hearing your views on that topic. Many votes so far, so I'll leave it open for another couple of seconds. There is some diversity in views, but overall a relative majority agreeing with the board.
Paolo, did you share the screen?
I think it's shared, hopefully.
Okay.
We can move to the next topic. I hand it over to you.
Okay, perfect. Thank you very much, Paola. And that takes us to concluding remarks. So to conclude, I would like to summarize the effects of the board's preliminary views set out in the discussion paper. Today, the acquisition method is applied to business combinations in the scope of IFRS 3. No IFRS standard applies to business combinations under common control. And companies use the acquisition method and a variety of book value methods to report such combinations. Under the board preliminary views, the acquisition method would be applied to business combinations and to similar business combinations under common control, of course, subject to the cost-benefit trade-off. And a single form of a book value method would be applied in all other cases. In other words, the existing distinction, which is somewhat arbitrary distinction between business combinations and business combinations under common control, is replaced by the consideration of whether and when business combinations under common control are similar to business combinations. The board's proposed approach is designed to provide useful information about all business combinations under common control, also to provide similar information about similar transactions, and to improve transparency in reporting business combinations under common control. The discussion paper is open for comment until 1st of September 2021, and the board plans to start discussing feedback on the discussion paper in the last quarter this year. We invite you all to comment on the board's preliminary views. So with that, we will now try and answer some of the questions that were submitted in our presentation. Carla, there are a couple of questions about the scope of the project, and so given you've talked about the scope, I will address those questions to you. So could you please comment on why the board is only looking at business combinations under common control, but not related party transactions more broadly? And in particular, would transfers of associates under common control be in the scope of the project? And also there is another question, what happens if a company that is transferred does not have a business? Is that in the scope or not? Carlo, over to you, please.
Sure. Thank you, Julia. So we are not considering common control transactions more broadly because there are already IFRS standards applicable to these transactions. So there are no scope exclusions in those other IFRS standards for common control transactions, unlike in IFRS 3. So for example, you said associates. So transfer of associates under common control is not addressed by this project because there is already an IFRS standard that applies to acquisitions of associates, so IS 28, so which doesn't exclude common control transactions from its scope. So similarly, if what is transferred is a legal entity that is not a business, so say for example, a piece of land, so a transfer of land within IAS 16, it doesn't exclude common control transactions. So hopefully that answers the question.
Okay, thank you very much, Carla. Just looking at the questions we have. Paolo, there is a question about how the acquisition method would be applied, and given that you covered the topic, I will pass it over to you. And the question really is, well, why did the board even consider making any modifications to IFRS 3, and why the board is actually not proposing that a receiving company will be required to identify, measure, and recognize distributions? Over to you, Paolo, please.
Thank you, Julia. Thank you for the question. The board is proposing a change to IFRS 3 to address a feature of a business combination under common control that is not present in other combinations covered by IFRS 3. Specifically, the consideration paid in a business combination under common control might be directed by the controlling party. So any difference between that consideration and what would have been paid in a, let's say, a regular business combination probably indicates that the combination includes an additional component, a contribution to the receiving company's equity or distribution from its equity. However, the board decided in its preliminary view, decided that not to require a receiving company to identify, measure, and recognize a distribution from equity. That's because distribution to the controlling party are unlikely to occur when a combination affects non-controlling shareholders. As I said during the presentation, many jurisdictions have legal requirements and regulations that are designed to protect the interests of non-controlling shareholders. And in addition, such an overpayment will be difficult to measure. The board considered a similar issue when it developed IFRS 3 and concluded that in practice, any overpayment will be difficult, if not impossible, to quantify.
Okay, thank you very much. So there is one interesting question that I will probably take myself, but it deals with how to draw the line, so to say. And the question is, what happens if non-controlling shareholders also owned a similar non-controlling share in the transferring company, in the selling company? Does it mean that they're affected? Does it mean that they're not affected? And which method would be applied? So I would like to start answering this question by saying that for now, the board is looking to lay down the foundations of the model. And once the foundations of the model are confirmed, the board can discuss various specific and nuanced scenarios. Having said that, and here I'm expressing my personal view, I would argue that if we apply the logic of the discussion paper to this example, non-controlling shareholders are not affected. So if non-controlling shareholders hold exactly the same share in both the transferring company and the receiving company, then as a result of the transaction, they do not acquire residual ownership interest in the transferred company. But just to be very clear, in that case, I mean it's the same non-controlling shareholders. If we have one group of people holding a stake in the seller and another group of people holding a stake in the receiving company, that's a different story. But if it's the same primary users, the same investors, and their economic interest does not change, then I would personally argue they're not affected. So that's a personal view. Right. So there is another question which has to do with scope, and I will let Carla to start answering that, and then if I have some additional comments, I will add them. So Carla, can you please comment on whether mergers are in the scope of this project? I think we maybe lost connection. So let me take this question myself. So again, the key principle is that what we look at in this project is transfers of businesses under common control. If a business under common control is transferred, regardless of whether it's followed by the legal merger or not, it will be in the scope of the project. However, let's say if a parent already owns a subsidiary and they merge and there is no transfer of business, then it's not in the scope of the project. Or if we have more complex scenarios where there is a group of entities, there is a parent and multiple subsidiaries, and then they all merge together, then it's necessary to consider facts and circumstances of this particular transaction to see whether there has been a transfer of business. And if so, that would be in the scope of the project. And I just realized that I've stolen a question from Carla and he was on mute, but here we go. Carla, I have another one for you. And this one is not actually on the scope so much, but more about the reason for the project, if you will. And the question is, so in practice, companies often apply a book value method. So is the project even needed if we have some sort of prevailing practice today? I'll let Carla take him off mute. Thank you.
Sorry about that, and thank you for the question, Yulia. So not all companies use a book value method. In some cases, companies also use the acquisition method. Further, as stated earlier, a variety of book value methods are used in practice. But more importantly, the project isn't about eliminating diversity in practice. It's also about providing better information to investors. There's currently a lack of transparency and comparability in reporting these combinations. In many cases, little information is provided about these transactions. Yeah.
Okay, perfect. So there are a couple of other questions, and there is one logistical question that I would like just to get out of the way. So there is a question of how to get a copy of the slide presentation. Just to reiterate, so the recording of this webinar will be available on the project website, and the slides used in this presentation will also be available for the download on the project webpage after the webinar, so you can get the copy of the slides. It's no problem at all. Now, there is a question about how a book value method would be applied that I will take myself, I think. And it's quite a nuanced question, and it basically is about what happens if there is a delay between the acquisition date and the legal registration of the business combination, and which book values we should be using. And in answering that question, I would like to, again, sort of maybe answer a broader question and to reiterate what Paula was saying earlier. So at the moment, as you have seen in this presentation, there is a large diversity of views about this topic. And it's really important that as a first step in this long journey, the board first establishes the main foundations of the model. And then once those main foundations of the model are established, then the board could consider various nuanced cases. For example, the question that is asked, what to do if there is a delay and which book values to use, or there is another question that we often get, and we received this question actually earlier this morning. And the question is, well, what happens if the transferred company did not prepare IFRS financial statements and they do not have IFRS book values? So what book value should be used? So all those topics will be considered in the future by the board once we know broadly where we stand in the model. And I suppose perhaps maybe one or a couple of questions before we conclude this presentation. Carla, another question for you, and it has to do with the board's approach. So can you clarify, we talked about it, but can you clarify, did the board consider substance of the transactions in developing its preliminary views?
Yep, that's a good question. Yes, it was considered. For example, from the receiving company's perspective, all business combinations under common control have substance because the receiving company now has a control of a business that it didn't control before. However, using the notion of substance as a way of deciding which method should be used for business combinations under common control will be problematic. For example, some stakeholders advocated using a set of indicators to evaluate the substance of a particular transaction. However, it would be difficult to develop a workable set of indicators for companies to use. That approach would be subjective and might not help reduce diversity in practice. Instead, the board focused on how similar a business combination under common control is to a business combination covered by IFRS 3 by looking at changes in ownership interest in the economic resources transferred in that combination. So that occur in a combination that affects non-controlling shareholders of the receiving company. I hope that answers the question.
Okay, thank you very much, Carla. And perhaps I will take one more question before we conclude. And the question is how the choice of accounting treatment, and in particular, if the acquisition method is applied by the receiving company, what happens at the controlling party level and whether any fair value adjustment would be eliminated. Just to reiterate again, that in this project, we are looking at the financial statements of the receiving company. We are not looking at financial statements of the controlling party because those questions are already addressed by existing IFRS standard. But of course, in this particular case, from the controlling party perspective, business combination under common control is an intergroup transaction, and at the controlling party level, the sets of intergroup transactions would, of course, be eliminated. So I think that this brings us to the end of our webinar. Thank you very much for your participation, for submitting your questions and participating in our surveys. And we look forward to hearing your views on the discussion paper. Thanks again and goodbye.